Welcome, market participants, to another Three Things in Credit. I'm Van Hesser, Chief Market Strategist, KBRA. Each week, we bring you three things impacting credit markets that we think you should know about. So we're post-earnings, post-jobs, post-CPI, PPI, post the changing of the guard at the Fed. We should be moving towards sell in May and go away, right? Well, not so fast. With geopolitical drama intensifying and AI moving, in the usually staid words of the Wall Street Journal's Greg Ip, from a welcome tailwind of growth to a hurricane-strength weather system distorting practically everything about the economy. Now, it's bound to be a busy summer. Buckle up. This week, our three things are: 1. Jobs rebound. Have we reached an inflection point? 2. Shock watch. Inflation, energy, food are all set to move the wrong way. Is this priced into risk? And 3. Historic uncertainty. 3 experienced voices weigh in on what's in front of us. All right, let's dig a bit deeper. Jobs rebound. So we've worried for some time now about the jobs market on a number of fronts, despite the low unemployment rate. We worry that there are enough workers to meet the demands of a solidly growing economy. We worry about a skills mismatch as we transition to a more technologically enabled world. And we worry about the impact of AI. But we aren't alone. Many members of the FOMC have worried about these issues, judging by what they say. I'm looking at you, Chris Waller, and how they've voted on monetary policy. Yes, there were 3 hawks dissenting over the statement at the last meeting, but a solid majority of voters, that's 9 of 12, voted to maintain an easing bias. And for good reason. So if we strip out lower paying jobs, healthcare, private education, and leisure and hospitality, private sector job growth has contracted by 608,000 jobs over the past 2 years. Now, using a 3-month moving average, job growth has been only positive in 7 of the past 24 months, and the highest month was just 22,000. But 2 things have seemingly changed. 1, inflation has proven to be stickier than expected, and 2, the jobs picture has brightened a bit, judging by growth in private non-farm payrolls over the past 2 months at 123,000 and 190,000 respectively for April and March. Now, stripping out, again, those lower wage categories, and those figures dropped to 70,000 in March and 63,000 in April. The Fed tells us, and the data supports, that those are sufficient to keep unemployment low. But is that enough to fuel at or near potential economic growth? Well, maybe, if productivity gains continue to deliver. So while we agree with market sentiment that inflation remains the more pressing of the Fed's 2 risks, the underlying vitality of the labor market continues to face headwinds. All right, on to our second thing, shock watch. Stocks are at or near all-time highs. Credit spreads are at or near all-time tights. While that might feel like a familiar refrain, there's been a lot of chop to markets over the past year. Each time we found ourselves in a place where risk was well bid, we got hit by a shock. Tariffs a year ago, labor market concerns last fall, conflict in the Middle East at the end of February. Each episode was met with favorable policy response and/or statements, paving the way for investors to refocus on the strength of earnings in general and the tech AI trade in particular. So we're back on shock watch. In our most recent quarterly outlook piece, The Forward Look, U.S. Credit Insights, Q2 2026, among the factors we highlighted as being particularly determinative to credit market performance were 1, the path of inflation, and 2, commodity price volatility. On the path of inflation, the energy price spike is being felt directly now and will be in the future as supply chains and plastics and chemicals are impacted. Then throw food into the mix as the fertilizer squeeze takes hold. Our first look at inflation data came out this week and the news wasn't great, but not as bad as the headlines. CPI was less concerning due to an overstatement of inflation related to distortions in the shelter data due to the government shutdown. Still, surges in the price of airline fares and delivery services reflect the energy rise, tax, and second-order effects, and expectations are likely to build from here. PPI also came in hot, especially trade services, that's warehousing and transportation, and core goods prices, but non-trade services were well behaved. Up next, food prices, still well behaved, but lagged effects of energy and fertilizer will clearly be felt over the near term. We also worry about the effects of 2 extraneous forces, AI and military conflict. The sheer magnitude of the AI build-out represents a material positive demand shock, an arms race for chips, software, computers, and peripheral equipment. It's also driving construction in data centers and power plants. These investments, representing roughly a third of U.S. growth, compete for resources. Much of the same can be said for military hardware, although the scale of that build-out is not quite as large. The energy spike is also hitting food production, where it's an important input from farming to packaging to shipping. Then there is the cost of fertilizers, also disrupted by the strait, and you have the prospects of higher costs and shortages not only this year, but next. Thus far, investors have taken all of this in stride. Needless to say, higher inflation and demand destruction are not credit friendly. That said, both will be better defined in the weeks and months ahead. Something to watch. All right, on to our third thing, historic uncertainty. So in this business, you have to be able to separate rhetorical excess from, well, rhetoric. And I thought about that when two highly regarded economics and markets thought leaders, Ray Dalio, founder of hedge fund Bridgewater, and David Folkerts-Landau, global head of Deutsche Bank Research and group chief economist, expressed views of the current state of affairs. Mr. Folkerts-Landau opined that we are entering a world of historic uncertainty. Now, Mr. Dalio struck a similar chord in an interview conducted by New York Times columnist Russ Douthat, saying that there will be huge changes over the next 3 to 5 years, and it'll be a period of great change and great turbulence. He added, on the other side of that, it will be almost unrecognizable. Okay, then. Mr. Folkerts-Landau warned that the challenges ahead are largely unknown and immeasurable. We face a landscape where we do not know what we do not know. He expects there will be a continuing explosive growth on non-biological intelligence, and that, by 2030, humanity will likely share its planet with an intelligence far superior in all cognitive and intellectual domains that may have profound implications for our daily lives, institutions, and governments. The basis for Mr. Dalio's vision lies in what he describes as three orders that are breaking down in the U.S. a monetary one, a domestic, political, and social one, and an international one. In the U.S. today, Mr. Dalio believes there is too much debt, big gaps in wealth and values, and a changing world order, and all three have made the country vulnerable. He adds that the advent of AI and increased risk of acts of nature, that's climate change and pandemics, will act as catalysts to change, increasing disorder. All of this reminds me of a letter Howard Marks of Oaktree wrote in the wake of the administration's tariff announcement a little over a year ago. Mr. Marks warned that there's no such thing as foreknowledge here, just complexity and uncertainty, and we must accept that as true. This means that if we insist on achieving certainty or even confidence as a precondition for action, we'll be frozen into inaction. Or, I dare say, if we conclude we've reached decisions with certainty or confidence, we'll probably be mistaken. Now, is all of this just rhetoric or rhetorical excess? Well, probably, hopefully, a bit of both. In any event, it argues for diversification and up-in-quality portfolio construction. So there you have it. 3 things in credit. 1, jobs rebound. We've bounced, but headwinds to growth remain. 2, shock watch. Keep an eye on inflation as well as the price of oil and food. Expected moves are not currently priced into risk. And 3, historic uncertainty. A lot of change is on our doorstep. Diversify and maintain a higher quality bias. As always, thanks for joining. Don't forget to check in on kbra.com for our ratings reports and our latest research. We'll see you next week.